So I've been allocating a small portion of my portfolio to gold for many years now. Not much, 4 5%. But looking at how the price of gold has gone up in the last 1 year, all I can say is so basically, gold turned out to be Mera, Tera, and Sabka hero number one with a 1 year return of around 30%, which is a tad higher than what the Nifty 50 managed to deliver. If you are familiar with my channel, you know that gold is not a new topic here. There's already a video on the different ways of investing in gold, and there's another one on buying opportunities focused specifically on sovereign gold bonds. Actually, SGB is now a very touchy topic, and if you've been keeping track, while the government of India has raised over 70,000 crores since 2015 through 67 tranches, the last issuance came in February of this year, which means there hasn't been a single issue in this financial year. Why is that the case? Well, very simply, and I'm sure even RBI officials will agree, sovereign gold bonds have turned out to be one of the most expensive borrowing tools for the government. In fact, to discourage consumers, the RBI has already announced premature redemption of 30 SGB tranches that were issued between May 2017 and March 2020, making it very obvious that the government of India, the Ministry of Finance, is not interested in sovereign gold bonds anymore. And you know what? I think the Indian consumer isn't interested either, especially after the government lowered the import duty on gold from 15% to 6%, making everything else, physical gold, digital gold, gold ETFs, and gold mutual funds, a lot more attractive now. Right, so this sets up the context, and in this video, I'll put up a case for investing in gold via ETFs, exchange traded funds, as I take you through how gold ETFs work, including their construct, their portfolio, etc. How is it different from physical gold, digital gold, and SGBs? The many benefits of using gold ETFs, their performance over the years, specifics like expense ratio, exit load, taxation, etc., and all the glitter and litter that comes along when investing in an ETF instrument. The latest offering in this category is the Groww Gold ETF, which we shall be taking a closer look at later in this video. Let's begin. So these are two words, gold and ETF. Let's start with why one should invest in gold, and very quickly, gold is an effective portfolio diversifier, and because it has a low correlation with other asset classes like equities, it helps bring down the volatility in one's portfolio. It also acts as a hedge during uncertain times, often preserving wealth during market corrections, conflicts, etc., with the price of gold moving inversely to inflation, interest rates, and currency depreciation. Thirdly, gold can't be created, as in it's a rare commodity, and from what I've read, there are only 52,000 tons of it that is yet to be mined, which makes gold pretty valuable. And in terms of long-term performance, gold has delivered returns of around 9% over the past 40-45 years. This is global performance. We'll look at India very soon, including how gold ETFs have performed. But to put it in a nutshell, with gold, you get safety, there are diversification benefits, the demand will often exceed the supply, and in terms of returns, it does a pretty good job. Okay, now that we've established that Sona asli mein Sona hai, let's understand ETF kitna Sona hai. Actually, ETF nahi, because I've already explained it in my previous video. Let's look at gold ETF kitna Sona hai. अरे देखने यार गोविंदा जी को बहुत हिचकी आ रही होगी तो पानी वानी पिला देना ठीक है रोलिंग है कंटिन्यू करें ठीक है Right, so in terms of features and benefits, here are the top points. A gold ETF predominantly invests in physical gold and gold related instruments, as in the ETF units are actually backed up by physical gold, which is not the case when it comes to SGBs. Secondly, the gold I'm referring to here has a purity of 99.5% or higher, which is also something the SEBI, the Securities and Exchange Board of India, requires all ETFs to have. Unlike physical gold, which might have different prices in different cities, like 10 grams of gold in Delhi is 77,815 rupees, while it's 70 rupees more in Kochi, so there are distortions. But with ETFs, you have price parity, so no matter where you are, the price remains consistent. What else? Yes, the ticket sizes are super low, and you can buy gold ETFs for as low as 1/100th of a gram of gold. Of course, this might not apply to every scheme, but it's definitely the case with Grow's gold ETF offering. And to explain this in numbers, 1 tola gold, एक tola of 24 karat gold is some 78,000 rupees, which means 1 gram is 7,800, which means 1/100th of a gram is 78 rupees. Now, I'm not saying or asking you to buy gold worth 78 rupees, but I'm sure you get the picture. That is, gold ETFs can be bought in low ticket sizes. Okay, we are on benefit number 5, and since ETF units are held in demat form, there's no worry of theft and neither do you need to worry about storage issues. And finally, in terms of transacting, one can buy and sell gold ETFs during market hours through your trading account, and more importantly, this transaction is without any markup or limitations, which is generally a challenge with all other popular alternatives. Okay, now that I've said it, here's a quick table of where gold ETF stands in comparison to other instruments like physical gold, digital gold, and sovereign gold bonds. So we have a number of variables here: the form of holding, safety, purity, pricing, tenure, total returns. I'll be taking this part separately for ETFs. What else? There's liquidity, minimum investment, lock-in period. So there are a bunch of parameters to compare, and it's not difficult to understand where gold ETFs have a superiority over the others. So pause this video if you have to, but please make sure this comparison is absolutely clear and do refer to it the next time you consider buying some gold. Right, so before we get into how gold ETFs have been performing, let's first understand how is gold valued. Now, as is the case here, the SEBI has defined some clear guidelines and rules on how gold needs to be valued, and of course every AMC needs to adhere to that. More specifically, the value of gold is determined on the basis of its price on the LBMA, the London Bullion Market Association, which is also considered the global benchmark. These prices are subsequently converted into Indian rupees, and to do this, we add the cost of transportation from London to India, plus notional customs duties, taxes, and any additional levies associated with importing gold into the country. The AMC then appoints custodians to handle the physical gold, who in turn would appoint a vaulting agency to store it safely. So there's a lot to do, a lot of expenses, which is exactly why gold ETFs have an expense ratio that includes the charges around transport, storage, handling, as well as an insurance cover. And in spite of all these expenses, the SEBI has also put in an upper limit of 1% to the gold ETF's total expense ratio, which is of course good news for investors like us. Okay, now on to performance, and as a part of my research, I first examined all existing gold ETFs, and what comes across is that there isn't much difference on the performance front, with maybe 0.1% here and there. So I'm guessing the choice of AMC doesn't matter much. But to understand it as a category, gold ETFs have delivered a return of 28.5% in the last 1 year, which is a bit high, not exactly the trend, while on a trailing 5-year basis, this came to a more rounded 13% return. I even looked at these numbers on a rolling basis, and now you can see where my earlier assertion of gold having a long-term return of 9% comes from. In fact, in the Indian context, this is more like 7.5–8% from the data I've compiled. But if you want a single return expectation number, then I'll say go with 9%. But remember, one doesn't invest in gold to make a lot of money. There are instruments like equities, venture capital, even real estate that can do a better job of this, but where gold and gold ETFs really helps is when you need it the most. For example, whenever the equity markets have fallen into hard times, like during the dot-com bubble, the global financial crisis, or recently during COVID, if an investor had some amount of gold in their portfolio, then your landing would have been a lot softer than most others, showcasing gold's ability to cushion the impact, to protect the downside, which I'm sure is something all of us would appreciate. In fact, I was going through the study, and to quickly summarize it, if one adds a marginal amount of gold in one's portfolio, and in this case it was 15%, then not only will your portfolio's volatility be lower, but your portfolio's returns would actually be on the higher side, as we can see here in all three scenarios. This reminds me of a similar study I had done last year in my video on asset allocation, where again I proved it with numbers that a portfolio with a mix of equity, debt, and gold with annual rebalancing can deliver a higher risk-adjusted return when compared to a 100% equity portfolio. So what's the moral of this story? As you continue expanding your portfolio with equity and debt instruments, be sure to allocate some space for gold investments as well, as this not only enhances your portfolio's risk-adjusted returns, but also comes with stronger downside protection. You know what? That's a bit like my weekly investing newsletter, isn't it? a bunch of well-researched investment stories which I hope will one day become the gold standard in equity research as I feature some exciting and potential profitable ideas. Zaggle Prepaid's impressive growth and international ambitions, Sky Gold's continued rise fueled by lower gold prices and increasing consumer demand, the story on Raymond Lifestyle and how its recent demerger has created a potential mispricing opportunity, Seagull India's growing ambitions and order book in the EPC space, and most recently, how and why Garware High-Tech Films Limited is likely to double its EPS over the next 2 years. All this is a lot of research, a lot of reading, but it's all worth it when we see these ideas translate into real profits. If you haven't subscribed to my newsletter, then kindly do so now and also tell your friends about it. Now, one fine place to start your gold journey, or if you've been keen on purchasing more, is the Groww Gold ETF, whose NFO is currently open for subscription and it closes on the 18th of October. Grow's offering is an open-ended exchange-traded fund that replicates the domestic price of physical gold based on LBMA's daily spot fixing price, with the objective of generating returns in line with the domestic price of physical gold, which is also its benchmark. The ETF does this by allocating 95 to 100% of its assets in physical gold and other gold-related instruments as permitted by the SEBI from time to time, and the balance 0 to 5% of assets go into debt and money market instruments, which help the ETF manage redemptions and other scenarios. There is no exit load here, and as I explained earlier, the maximum TER, that is, the maximum total expense ratio permissible under Regulation 52(6)(b) is up to 1%. In addition to the expense ratio, and I'm saying this because some viewers had asked me this question in a previous video, so because these are ETFs, there might be some other expenses here. So things like demat charges, AMC charges, brokerage, exchange transaction fee, etc., that might be payable at the investor's end. So please be aware of how big or how little those charges are. Since the Groww Gold ETF will be listed on the stock exchange, investors can conveniently buy and sell units, providing them with liquidity and transparency. Presently, one can purchase small units of the ETF, with each unit representing 0.01 grams of gold, making it very accessible for investors. The Groww Gold ETF can also double down as collateral for loans, which adds an additional layer of financial utility for investors. And in terms of risk, the scheme and its benchmark are categorized as high risk per the riskometer. So these are some of the scheme's salient features, and we as investors can participate in the NFO with an investment of as little as 500 rupees. For more information on all of this, do check out the link I've attached in this video's description. The fact is, gold ETFs have seen a surge in interest over the last few months, with over 1,300 crores invested in July alone, and I suspect the recent reduction in customs duty might have something to do with that. Another catalyst for gold ETFs are the recent budget announcements, and from what I've understood of the tax rules, not only has the holding period come down, but in some scenarios, even the tax rate has seen some relaxation. Now, as you all know, taxation isn't really my forte, so I strongly recommend consulting a tax advisor to ensure you're fully optimizing this aspect of your investments. However, when I consider these tax changes, the drop in customs duty, and the upcoming festive season with Diwali around the corner, it feels like the Groww Gold ETF has launched at the perfect moment. If you're an investor who hasn't explored gold, or if you're underexposed at the moment, then do try to have 5 to 10% of your portfolio allocation in gold. Once again, thank you for your time. Do like this video, do subscribe to my newsletter, and I'll see you very soon. Until then.